Welcome back to Beyond the Benchmark. I'm Ryan Kasper. In a lighter year-end trading week, the economic data flow was fairly thin, but still offered a useful snapshot of how markets are entering 2026, with growth slowing modestly, inflation still sticky in spots, and policymakers navigating a careful balancing act. On the housing front, home prices showed small gains, but continued to decelerate. The FHFA House Price Index rose 0.4% in October, while the Case-Shiller Index was up 0.3 on a seasonally adjusted basis. Year over year, national home prices are up roughly 1 to 2%, which now trails inflation and marks one of the weakest periods of price appreciation since mid-2023. Elevated mortgage rates and affordability pressures continue to weigh on buyer activity, and the housing market remains sluggish as we move into the winter months. Labor market data was one of the brighter spots. Initial jobless claims fell sharply to just under 200,000, with continuing claims also declining more than expected. While seasonal effects can distort these numbers at year-end, there were no major red flags in the data, suggesting the labor market remains resilient, even as broader growth cools. The Federal Reserve minutes from December highlighted continued divisions within the committee. Most participants still expect rate cuts over time, but some favored holding rates steady for longer due to concerns that inflation progress may have stalled. The minutes reinforced the Fed's challenge, balancing elevated inflation risks against a labor market that has softened somewhat since mid-2025. Futures markets continue to price in roughly 2 rate cuts during 2026, which would bring policy closer to a neutral level near 3%. Turning to markets, U.S. equities pulled back during the low-volume holiday week, with most major indexes finishing lower, though 2025 still ended as the third consecutive year of strong double-digit returns. Energy was the standout sector, helped by firmer oil prices, while technology, financials, and consumer discretionary lagged. Despite the short-term volatility, optimism around artificial intelligence and expectations for continued fiscal support are helping keep longer-term growth sentiment intact. International markets told a different story. Stocks overseas finished higher, led once again by emerging markets, particularly South Korea and Taiwan, where technology exposure remains a key driver. A major theme of 2025 was the re-emergence of international equities, as growth prospects abroad improved relative to prior years, drawing renewed investor interest. Bonds lost a bit of ground as yields ticked higher across the Treasury curve, though high-yield and floating-rate loans held up relatively well. Commodities were mixed, with strength in industrial metals, energy holding steady amid geopolitical developments, and a pullback in precious metals after a strong year. Oil prices edged higher on rising tensions in the Middle East and Venezuela, though ample global supply continues to cap upside. So the takeaway as we open the new year is this. Markets are transitioning out of a strong 2025 with measured optimism. Growth is slowing but still positive. Inflation remains a watch point, and diversification continues to matter as policy, geopolitics, and global growth dynamics evolve. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. We appreciate your partnership, and we'll see you next week.